Welcome to the Stock Market Palantir. Today we are going to talk about VEE. So Twin V Power Cats Co. That's VEE. It presents one of the most compelling microcap special situations I've seen in a while. This is a marine manufacturer, and it's just gone through this really dramatic structural and operational overhaul in 2024 and 2025. We had the Forza X1 merger, a big reverse stock split. The real question for investors, I think, is this. Does the recent, very tangible operational turnaround, I'm talking about the Q3 2025 margin expansion, the asset sales, does that provide a stable foundation for an immediate revaluation? Or is the stock just fundamentally stuck because of these aggressive market microstructure dynamics? I'm talking specifically about dark pool shorting and, of course, the low float. I believe the fundamentals are finally there to break free.
See, I think those microstructural problems are really the main story here. I think they're going to overpower any fundamental improvement, at least in the near term. The VEE story isn't just about, building boats more efficiently. It's about a company trying to fix its balance sheet while it's being, actively suppressed by institutional algorithms.
I see why you'd think that, but let me offer a different perspective. VEE has pulled off a true great reset, and the market is just spectacularly mispricing it. It's trading the entire company near its net cash floor. We have to focus on the Q3 2025 financials. The key signal, really, is the 910 basis point expansion in gross margins, pushing them up to 13.8%. That jump isn't just a number on a page. It is concrete evidence that they are manufacturing boats much more efficiently and have found some new pricing power. That kind of turnaround should demand a higher valuation multiple.
Okay, the margin expansion is certainly important. I'll give you that. It's important for long-term survival. But it exists inside a capital structure that is frankly fundamentally fragile. I come at it from a different angle. While the operational story is getting better, the market microstructure data, it reveals this intense institutional skepticism that just prevents any kind of sustainable upward momentum. And I'd point directly to the FINRA trade reporting facility data. On November 7th, 2025, the day after their positive earnings came out, we saw what I can only call an extreme statistical anomaly. The off-exchange short volume ratio spiked to an astonishing 85.93%.
Wow, an 86% short ratio, and it's happening off-exchange. That is certainly alarming on its face.
It's more than alarming. It's the mechanism of suppression. When 86% of the trading volume is happening away from the public eye, that's a direct sign that institutional algorithms are aggressively capping any upside momentum. It prevents the proper price discovery that you'd expect after a good earnings release. And on top of that, the whole post-reverse split capital structure is just too thin. Now, the reported short interest looks low, but the days to cover metric is just 1.48. That means the short sellers can get out of their positions in less than 2 days. So there's no real fear of a short squeeze, which guarantees that all this high volatility doesn't translate into any lasting gains for the stock.
Okay, but let's focus on the certainty of the floor for a second. The non-dilutive sale of their North Carolina property for $4.25 million. That fundamentally de-risks the equity. When the market cap is bouncing around between $4 and $5 million, the stock is basically trading at the cash value of one piece of real estate. That assigns zero value to the operational business, the brand, the IP, anything. That cash, combined with the successful pivot towards the higher margin Bahama Boatworks line, it should mandate a revaluation. This structural cleanup completely outweighs that historical pattern you see, that, post-split gravity.
Yeah, that's a compelling argument, but have you considered that the stock has already lost roughly 50% of its value since the April 2025 split? Post-split gravity, that depressing, predictable pattern where a stock just keeps falling after a reverse split because the underlying problems aren't solved, that's already happening to VEE. And besides that, the cash benefit is kind of muted by their capital structure history. Remember the May 2025 public offering? 750,000 shares at $4? That caused a massive supply shock. It dramatically increased the low post-split float, and I think investors are still acutely wary of future dilution. And that, right there, caps the upside, regardless of a $4 million cash cushion. And I think we need to understand that dark pool activity not as some random anomaly, but as a deliberate strategy.
That 86% dark pool short ratio on November 7th, and then the 57.5% short ratio on November 18th, which came with a big price drop, it confirms that off-exchange shorting is the primary tool for suppression here. Institutional capital is using every single liquidity spike, like that 15 million share volume surge on November 17th, to just distribute shares. They're trapping the late retail investors who bought into the turnaround story, and they're doing it where their actions are mostly hidden.
I'm not so sure I buy that line of reasoning, because the dark pool activity could just be liquidity provisioning by market makers. We have to consider the hedging angle. When retail investors flooded in after the Bahama Boat Works production announcement on November 12th, market makers have to short shares to hedge their positions and provide that instant liquidity. The underlying fact, which I think we can agree on, is that the business is improving. It's successfully moving to luxury models, focusing only on the noise created by the reverse split and the microstructure. It just obscures the tangible operational turnaround, which is really the only thing that creates lasting intrinsic value in the end.
But the noise creates a behavioral constraint that dictates the price action right now. Retail sentiment is completely fractured. It's creating what I'd call a sentiment liquidity trap. New investors are, well, genuinely repelled by the corporate history. You have the complexity of the merger, the reverse split, and then this constant litigation noise from automated posts about class action lawsuits. The stock just lacks a natural, organic bid from new retail money, which leaves its price entirely dependent on these fleeting catalysts that, as we've already established, are pretty easily suppressed by efficient off-exchange shorting.
That's an interesting point about the retail base, but I would frame it a little differently. The committed retail base, the ones who are still there, they're anchored by this follow the whales idea. They saw that past institutional accumulation data, the reports of a massive percentage increase in institutional shares. So this committed, though I'm sure very exhausted retail base is passively holding the line. They're refusing to sell, and that provides a sort of psychological floor that buys management the time it needs for the improved fundamentals, that margin expansion, to eventually mature and force the institutions to re-engage.
Time is a luxury I'm not sure VEEE has when it's facing such efficient and aggressive shorting.
To summarize my position then, the structural cleanup, the Forza merger, the property sale, creating a verifiable cash floor, that combined with the very clear operational efficiency gains means that company that's entering 2026 is fundamentally healthier and leaner. The current price is just an artifact of past corporate issues, not a reflection of its future potential.
And to reiterate my view, investors just have to account for market structure. While the fundamentals are getting better, yes, the structural reality of the low float, the non-existent short squeeze risk thanks to that 1.48 days to cover, and the proven ability of off-exchange activity to crush positive news like we saw with that 85.93% dark pool anomaly, it all means VEE remains a very high-risk battleground.
So the debate really comes down to whether you trust the fundamental turnaround, like the strong Q3 margin expansion, over the very real and aggressive market mechanics, like that 86% dark pool anomaly.
Exactly. The business seems to be fixed, but the stock market itself remains the real obstacle here.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.